What's up, guys? I'm Paul Piacentino with Keller and Realty, and I've got Taylor Craig here today with Gill Mortgage to answer some nail-biting questions that we get from our buyers and sellers on mortgages and a few other things about finances. So, Taylor, thank you for coming, first of all.
You're welcome.
And I always like to know, when you meet people out, right? You're at a brewery or a wedding and stuff like that. Someone asks you, hey, what do you do? What's your 30-second elevator pitch?
So I am the money guy. If you don't have the funds to own the house outright and purchase it, you come to me, you put a little bit of a percentage down, and you can get in that house.
So Taylor, we hear this a lot, right? I have buyers come to me and go, hey, I don't have the 20% to put down. Do they need 20% to put down on their home?
The answer is no. You do not need 20% to put down on home. You could actually start with 3%, sometimes 0. You don't have to put any money down, but 20% is to avoid mortgage insurance right from the start.
So what would be the times that someone would actually need to put 20% down or more?
So someone would typically need 20% down if they're getting a jumbo loan, a multi-unit property, or if they're just trying to avoid mortgage insurance right from the start.
So when we talk about 3.5%, 5%, 20% down, does that include closing costs?
No, that does not include closing costs. I usually recommend someone has 2 to 5% of the home sales price set aside to cover that.
So Taylor, when we talk about closing costs, right, we've got a percentage. What's actually included in your closing costs?
So closing costs consist of the originator's application fee. It could include appraisal fee, what the attorneys charge for recording, and then some prepaid taxes and insurance.
So Taylor, I hear a lot of great feedback from some of my clients that have worked with you. Can you tell us why they love you so much?
Whether you've owned a home before or this is your first time purchasing a house, we like to be there every step of the way, as informative as we can be, and the backing of my team is really, a strong point that we like to have.
We talked about closing costs and down payment. Overall, to prepare a buyer for getting into the market, what would you recommend, either a dollar amount or percentage overall, that they should have ready to go?
So anywhere from 5 to 10% is a good start. It allows you to cover the down payment and closing costs and still be able to close on time.
Would you say the pre-approval process is any different for someone that, say, is either in a salary or hourly job to someone that's in a commission-based job?
Oh, absolutely. So if you go from just something that is salary or hourly and you've been working there for a while and now you jump into something that's commission-based, let's say, it's all about measuring risk and the ability to repay that loan. So if we don't have enough history to measure that, it's probably not going to work.
Okay, so what is that amount of history generally that you need to see from someone?
We like to see 2 years history. We can get away with one with compensating factors, such as higher down payments and showing large reserves in the bank.
So this past year, right, we've seen historically low rates. I have a lot of clients come to me and go, I want that rate. How do they qualify for a rate such as that?
The biggest factor is going to be your credit score. The higher your credit score is, the lower your rates are going to be. And then the second thing would be your debt to income ratio. So it's measuring how much debt you have versus your monthly income, and it's going to be another compensating factor for us giving you lower rates.
So what's the difference between pre-qualification and pre-approval?
A pre-qualification is me asking you general questions such as what is your income, your revolving debts, and your credit score, so I have a general overlay of if this is going to work. A pre-approval is verifying those assets such as pay stubs, bank statements, and actually looking into your credit to make sure it will work.
So for someone in a commission-based job, like myself selling real estate, what would you need to see from me income history-wise to get pre-approved?
So typically we like to see 2 years of employment. It's all about measuring risk, and so the further back we can see that you've been making X amount of dollars is going to be mitigating that risk for us.
So I work with a lot of clients that are at the $850,000 price point and above. For those clients, it's a little bit different loan product, my understanding is, than someone that's buying a $300,000 house. What's the type of loan product and how do you qualify for that?
So that takes you into jumbo loan territory. If anything that goes over $647,200 is considered a jumbo loan. So that's where you need 15, 20, even 30% down sometimes.
So 2021 was a year of historically low rates. So we saw a lot of people buying and selling, but we also saw a lot of people refinancing their houses. What goes into a refinance?
So a refinance of a home is actually getting rid of the old loan that's in place and replacing it with a new one. It is to lower your interest rate, or sometimes there's cash out refinances.
So you mentioned cash out refinances. What is that, and is there a certain percentage you need to have equity in your home to do?
Yes, so cash out is accessing the money that's being held in the house. When you buy a house, that money doesn't disappear. It's being into the house. So you can access up to 80% of that home's value with a cash out refinance.
What are some tips and tricks that you give to clients to help pay off their mortgage sooner?
It's really building a game plan. If their credit is a little too low or they don't have enough money, it's me kind of telling them, hey, here's where we need to be to get you what you want.